Welcome back to Investing Talk Podcast. Today, we're tackling a really critical but maybe sometimes overlooked challenge facing, well, the hottest tech out there, artificial intelligence, specifically its energy dilemma. We all see the amazing things AI can do, right? But behind the scenes, there's this huge kind of hidden problem building up its massive appetite for electricity. We've got some excellent insights for you today, pulled straight from a recent Morgan Stanley report. We want to help understand what's going on, why it's such a big deal, and importantly, where the opportunities might lie for you as an investor. Our goal, like always, is to pull out the key takeaways, cut through the noise, and get you the info you need. And hey, before we jump in, if you're finding these conversations useful, please do hit that subscribe button, give us a like, maybe drop a comment. Seriously, if there's a specific company or industry you want us to look into, let us know in the comments. We do read them.
Yeah, definitely. And what's really striking here is just how fast this whole AI infrastructure thing has moved from, theory to actual large-scale reality. Morgan Stanley is really clear on this. Electricity is becoming the critical resource. Forget silicon for a second, it's the power. Think of it like the hard currency for AI. Without enough power, progress could seriously slow down. It's becoming a fundamental bottleneck.
That's a really important way to put it, hard currency. Okay, so let's dig into the numbers a bit because this Morgan Stanley report, powering AI in the U.S., it sounds like it lays out a pretty stark situation. How big is this demand we're talking about, and what's the actual shortfall?
Well, according to their estimates, just the new demand from U.S. AI data centers is set to hit something like 65 gigawatts, GW. And that's just between 2025 and 2028. Now, put that against what the U.S. grid can actually add in the short to medium term. They figure it's only about 21 gigaW reliably available. That's maybe 15 gigaW pretty much ready now, plus another 6 gigaW that's already being built. So you do the math. That leaves a potential power gap in the U.S. of nearly 45 GW. Just over the next, say, 3 to 4 years, it's a significant deficit.
Wow, okay, 45 GW, that's not just a number, that feels like a massive wall.
Yeah.
So for you, the listener, what does this actually mean? Is this a roadblock that could genuinely stifle AI growth, or is it an opportunity?
It's definitely both. It's absolutely a potential bottleneck. But this power gap, it's not just technical, it's fundamentally economic. It changes how you value things. Morgan Stanley even came up with this new idea. They're calling it time to power.
Time to power. Interesting.
Yeah. They basically see huge value stacking up in companies that can provide power solutions quickly. They're estimating maybe a $500 billion value reevaluation for the early movers in just the next 3 to 5 years.
$500 billion.
That's their estimate. And potentially climbing to $1.1 trillion total value creation by 2030. So put simply, the companies that figure out how to solve this AI power problem, they could become the really decisive players in the whole AI ecosystem. It shifts the focus,
Right. It's not just about the chips anymore. It's about plugging them in reliably. So solving this isn't just needed. It's potentially a multi-trillion-dollar play. Now, Morgan Stanley, they identify 4 potential solutions. And they even say that if all 4 are used, the U.S. grid might only just get to a roughly balanced state. That's telling. Let's break these down. What are the options, and which companies might be in a good spot?
Exactly. And these solutions, they touch different parts of the energy world. You've got repurposing old stuff, building brand new next-gen power. It's a mix.
Okay, first up is one that sounds, well, kind of unexpected. Repurposing old Bitcoin mining sites. I mean, talk about one energy hog feeding another. How does that work? Why is it efficient?
It does sound a bit odd at first glance, yeah. But think about it. Historically, a lot of Bitcoin investors, maybe they didn't fully value the actual power infrastructure they built, but these sites, they often have huge power connections already there. Substations, high-capacity lines, everything needed for enormous electricity draw.
Ah, okay. So the expensive part is already done.
A lot of it, yeah. So converting them into HPC high-performance computing data centers for AI is seen as a quicker way to tackle that power bottleneck. You're leveraging assets that already exist. The catch, though, according to Morgan Stanley, is if the price of Bitcoin shoots up.
Right.
Then miners might just keep mining, which would reduce the sites available for AI and probably push up the conversion costs.
That makes sense. A unique kind of market dynamic there. So you're basically swapping one type of energy-intensive computing for another, using the same plug. Which companies are actually doing this, making that pivot?
Well, a key example they point to is IRNS. Since about 2024, they've made a really clear strategic move. They're broadening out from just crypto mining into providing cloud services and solutions specifically for AI HPC data centers. And while their Bitcoin mining revenue is still projected to be strong, the report notes their AI cloud business is already running at an annualized rate heading toward $250 million.
Yeah, okay.
Yeah, so they're literally swapping out ASICs, those chips built just for mining, and putting in GPUs, which are what you need for AI. And they're investing heavily in new purpose-built AI data centers, too, using things like liquid cooling. They mentioned Horizon coming online late 2025 and Sweetwater targeted for late 2027.
That's a very deliberate shift.
Yeah.
Are there other companies Morgan Stanley mentions in this crypto to AI conversion space?
They do. They also sound pretty positive on names like Riot Platforms, Cypher Mining, Hut 8, and BitDeer Technologies. The big advantage here, really, for investors looking at this angle is speed and cost.
Right, faster than building from nothing.
Exactly. Converting these sites is generally quicker and cheaper than building a brand new data center complex from the ground up, so it helps meet that immediate, surging AI power demand.
Okay, interesting angle. But repurposing can only go so far. What about actually generating new power? Morgan Stanley points to two very different sources here, natural gas and nuclear power. How do they fit together in this picture?
Yeah, it's kind of a two-pronged approach they outline. Natural gas is positioned as the bridge.
The bridge, meaning short to medium term.
Exactly. As this AI data center demand just explodes, the whole natural gas supply chain, the producers, the pipeline companies, they're likely to benefit from locking in long-term, potentially premium price contracts. Morgan Stanley's analysis even suggests that a 20-year supply deal could push the value multiples for these gas suppliers, the EV to EBITDA ratio above 10x. That points to a pretty significant reevaluation of those assets. It's about providing scalable power fast.
Okay, so gas handles the immediate surge. Then there's nuclear, which the report calls the future's foundation.
Yeah.
Now, nuclear, it's had its challenges, right? Public perception, high upfront costs.
Yeah.
Does the report suggest why it's now seen as so critical for AI, perhaps overcoming some of those past issues?
It seems the sheer scale of the need is changing the calculation. You've got the tech giants, Microsoft, Amazon, Google. They're not just talking about it, they're actively investing in nuclear power now.
Directly investing.
Yeah. And it's not just about getting the huge amounts of power they need. It also helps them tick several boxes. One is meeting regulatory additionality rules.
Right. Explain that additionality bit again for us.
Sure. It basically means that for certain large projects, especially data centers, regulators require them to bring new power generation online specifically for their project. They can't just suck more power from the existing grid if it might strain supply or raise prices for everyone else. They have to add capacity.
Got it. So nuclear helps them do that.
Exactly. Plus, it supports their big corporate emission reduction goals, net zero targets. And crucially, nuclear provides very stable, controllable baseload power, 247.
So it's like a triple win for them. Additionality, emissions, reliability.
Precisely. The urgency of the AI power demand seems to be outweighing some of the historical hesitancy.
Okay, that makes sense. But the nuclear supply chain is famously complex. If this is a foundational piece, can you walk us through the investment opportunities Morgan Stanley sees across that chain, from mining the fuel to running the plants?
Sure, they break it down into roughly 3 stages. First is the upstream. This is all about raw materials and processing. So uranium mining is key here. Companies like Cameco, Uranium Energy, Energy Fuels, Denison Mines, NextGen Energy are mentioned, and also nuclear fuel processing, where Centrus Energy is the name that comes up. This part of the chain, it tends to have high barriers to entry, high cost to get started, which can mean strong pricing power for the established players.
Okay, upstream is fuel. What's next?
Then you have the midstream. This is more about the design, the R&D, and actually building the reactors. This is where the small modular reactor, or SMR, companies fit in. They mentioned NuScale Power, which was the first SMR company to go public. Also Oklo, which got attention because Sam Altman, the ChatGPT father, backed it. And nano-nuclear energy, which apparently aims to control the whole process, vertically integrated.
SMRs get a lot of hype for being smaller, potentially faster to build.
They do. But Morgan Stanley puts a slight brake on that excitement. They warn that large-scale deployment of SMRs might still be, realistically, a decade away.
A decade. Okay, so not an immediate fix.
Not immediate widespread deployment, no. And profitability in this midstream segment can be tricky because of construction risks, potential delays, and just long development timelines. Also, in the midstream, you have big equipment suppliers like BWX Technologies. They provide major components, reactors, often for government contracts like naval subs, but also for commercial power.
All right, so upstream fuel, midstream design and build. What's the final stage?
That's the downstream. This is about actually operating the power plants, selling the electricity, and dealing with waste management. This part usually provides very long, stable cash flows once a plant is up and running. Key players here are often the big utility companies that own and operate nuclear fleets. Names like Constellation Energy, Vistra Energy, American Electric Power, Southern Company, Exelon, Duke Energy, Public Service Enterprise Group.
The big utility names we know.
Exactly. And Morgan Stanley also points out that electrical equipment companies are crucial across the whole chain. Think GE, Vernova, Eaton, Honeywell, Emerson Electric, Graham. They provide all the vital pumps, valves, control systems, turbines, etc.
That's a really helpful breakdown of the chain. It sounds like politics and policy are also playing a pretty big role in nuclear's comeback story, right?
Oh, absolutely. The report mentions chatter about the possibility of a Trump administration, should it return, pushing for stakes in key industries, potentially including nuclear energy. That signals potential high-level backing. And more concretely, the U.S. Department of Energy just formed a new consortium specifically to build up a domestic supply of enriched uranium. That's a big move for energy security.
Building domestic supply. And what about existing plants?
We're seeing plants that were shut down actually getting approval to restart. Nextra Energy just got the go-ahead for the Duane Arnold plant in Iowa. That follows similar moves for the Palisades plant in Michigan and 3 Mile Island in Pennsylvania. So the trend is definitely towards keeping existing nuclear capacity online and even bringing some back.
But restarting isn't cheap, I imagine.
Definitely not. NextEra apparently told regulators it's a highly capital-intensive process. They plan to invest something like $100 million in just 2025 for that single restart. So yes, the long-term potential is there, but the near-term investment is significant.
Okay, so nuclear is a major long-term piece, but with big upfront costs and timelines. Let's pivot now to maybe quicker, more localized solutions. You mentioned microgrids and mobile power. With grid connections taking years sometimes, how do these help solve the AI energy crunch more immediately?
That's exactly their niche speed and reliability, where the main grid might be slow or insufficient. Microgrids are becoming a really important supplement for data centers. They offer that high power density needed, they can be deployed more flexibly, and crucially, they offer high stability. A microgrid can keep a critical facility running even if the main power grid goes down.
And Morgan Stanley singled out a company here.
They did. They see Bloom Energy as a core beneficiary in the microgrid space for data centers.
What is it about Bloom Energy's specific solution that makes it attractive for these power-hungry AI facilities?
Well, their always-on fuel cell microgrid, it offers several advantages that are really appealing for data centers. Things like very high-quality power, which sensitive IT equipment needs, high reliability. The units are relatively small, so you can build in redundancy easily. They offer high power density, meaning more power in less space, and flexible output.
And compared to waiting for the grid?
That's the key. Getting a traditional grid connection can easily take 3 to 5 years for permitting and construction. Even getting big equipment like gas turbines from, say, GE Vernova might have delivery times of 3 to 5 years right now.
Wow. Long waits.
Yeah. Whereas solid oxide fuel cells, SOFCs, like the ones Bloom makes, are modular. They can be deployed much more rapidly. They're also highly efficient and have lower emissions than, say, diesel generators. So even though the initial costs might be higher, the speed of deployment plus potential subsidies can make them very attractive, especially for AI timelines.
And Bloom has actually landed some big deals, right? That seems to validate the demand.
They certainly have. Bloom is a major player in SOFCs globally, with something like 40% market share for stationary fuel cells. They've announced significant orders from huge names like Oracle, Equinix, and AEP. The Oracle deal, announced July 2025, was specifically to power AI data centers, and they committed to delivering within 90 days. That's incredibly fast in the power world.
90 days versus 3-4 years, yeah, that's a difference.
Huge difference. They also signed a massive 1 gigawatt order with AEP, apparently the largest fuel cell purchase ever. And their deal with Equinix, the data center giant, covers over 100 megawatts across almost 20 sites. Bloom's current manufacturing capacity is about 1 gigawatt, and they're aiming to double that to 2 gigawatt by 2026 just to keep up with this demand.
That's serious scaling. Okay, so that's microgrids. What about mobile power? How does that fit in? Is it like generators on trucks?
Sort of, yeah. Mobile power is part of what Morgan Stanley calls a bridge development strategy. It's especially useful in places with those strict additionality rules we talked about, where you have to build new power alongside your data center.
Right, to avoid straining the local grid.
Exactly. So deploying mobile power sources could be natural gas generators, could be fuel cells on skids or trailers, allows a data center to start operating, maybe in phases, while they're still waiting for the permanent grid connection or their own larger power plant permits to come through. It bridges the gap. So companies that can quickly supply and deploy this kind of mobile equipment, the report mentions GE Vernova and Caterpillar here, are expected to benefit significantly from this need for rapid, temporary, or supplemental power.
Okay, that makes a lot of sense as a bridging tactic.
Yeah.
So let's try and bring all these threads together now. Thinking about everything we've discussed, the gap, the solutions, what are the core takeaways from Morgan Stanley's analysis for our listeners, for investors looking at AI and energy?
I think the main point Morgan Stanley makes is that AI investment is shifting phases. It's moving into what they call the payoff period, but with a really important condition, that electricity supply bottleneck. It's becoming the central factor that's reshaping how companies in this whole ecosystem are valued. So during this window we're in now, the energy companies, the infrastructure providers who can offer early power supply, rapid deployment, and meet those high additionality needs. Those are the companies expected to see the first wave of significant value appreciation. It's shifting from just who has the smartest AI model to who can actually power that model reliably and quickly.
It's really clear the race to power AI isn't just an operational challenge. It's actively creating this whole new investment landscape in the energy sector, shifting where the value is concentrated. And it leaves us with a really big question, doesn't it? As AI keeps reshaping our world, will this intense search for power ultimately push us towards a more resilient, maybe more diversified energy grid? Or could it actually create new kinds of vulnerabilities, new dependencies that maybe we haven't even fully grasped yet? Something to think about.
Well, thank you for joining us on Investing Talk podcast today. We really hope this look into AI's energy dilemma has given you some valuable food for thought as you navigate what's coming next in technology and energy investing.